You're scrolling your phone Friday morning. Breaking news, your bank just failed. Now what happens? Within 24 hours, federal regulators show up. The bank's doors lock. Your debit card stops working immediately. But here's the critical part, your money doesn't vanish. The FDIC takes control. They'll send you a letter within days. Then comes the waiting period. For most people, it's 3 to 7 business days. Silicon Valley Bank collapsed on March 10, 2023. Customers had their accounts back by March 13. That's 3 days. First Republic Bank failed May 1, 2023. Resolution took until June. The timeline depends on complexity. Lots of business accounts. Slower. Simple checking and savings. Faster. The moment the bank closes, the FDIC clock starts ticking. Your money is protected. Let's understand exactly how. Interest rates jumped from nearly 0% to 5% in just 1 year, 2022. SVB sat on $120 billion in bonds they bought when rates were locked low. Classic mistake, zero diversity. When rates climbed, those bond values collapsed, $15 billion in unrealized losses. On paper it looks bad, but here's the brutal trap, you don't lose actual money until you sell. But panic doesn't care about accounting. Tech companies, SVB's largest depositors, got spooked and started withdrawing cash. $42 billion left in a single week. SVB faced an impossible choice. Keep $15 billion in losses on the books or sell bonds and realize them. They couldn't do both. Signature Bank hit the same wall. Crypto deposits evaporated overnight. Withdrawals spiked beyond what they could handle. The pattern is always identical, trapped assets plus sudden panic equals collapse. Enter the FDIC. Federal Deposit Insurance Corporation. In 1933, after the Great Depression wiped out millions of Americans, Congress created it. One rule, banks must insure your deposits. Up to $250,000 per depositor, per bank. You keep every penny if the bank fails. A bank collapses on Monday. By Friday, you're whole. Your money transfers to another bank or you get a check. This system has worked for 91 years without a major failure. Think about it. You could deposit $250,000 in Bank A and $250,000 in Bank B. That's $500,000 protected. Different account types also count separately. A savings account and checking account. Both covered. A joint account. Different category. The FDIC has a reserve fund built from bank fees. When a bank fails, they tap it. No taxpayer bailout needed in most cases. That's the safety net. But what if you have more than $250,000? Smart move. Open accounts at different banks. Each bank gives you separate protection, $250,000 per institution. So $250,000 at Bank A, $250,000 at Bank B, all covered. That's $500,000 with zero extra risk. Joint accounts. You're doubling the coverage. Instead of $250,000, you're now at $500,000. You and your spouse each get $250,000 of protection on that same account. Perfect for household savings. Then there's retirement accounts. An IRA gets its own $250,000 limit. Your 401k is separate, fully protected regardless of amount. Employer plans don't have a cap. That's crucial. Let's say you have $800,000. Put $250,000 in a regular account at Bank A, $250,000 at Bank B, $250,000 in a joint account. $250,000 in an IRA at Bank C. All fully protected. Now you know exactly where each dollar sits. March 2023. Meet Sarah, she had $400,000 in a regional bank's business account. $250,000 was protected. The other $150,000. Uninsured. When the bank collapsed on Tuesday, she immediately panicked. By Wednesday, she couldn't access anything. The FDIC seized it. But here's what actually happened next. By Friday, the FDIC transferred her insured $250,000 to a new bank. Full access, no loss. The uninsured $150,000 was trickier. She was told it might take weeks, or months. She'd have to wait in line with other creditors. Some got partial recovery years later. Some lost it completely. Sarah was luckier than most. After 18 months, she recovered 92% of that $150,000. But 8% was gone. 3 years later, she's still dealing with the aftermath. This isn't theoretical. This is real timing, real money, real people. Here's your deposit protection checklist, 3 rules that actually matter. First, keep deposits under $250,000 per FDIC insured bank. Simple math. One bank fails, you're covered completely. Second, use different institutions for amounts over $250,000. Spread across 5 banks. 5 separate guarantees, all entirely free. Third, verify your institution is FDIC insured before depositing. Check the FDIC website. Takes 90 seconds, prevents surprises entirely. The panic stops here. 99.8% of all deposits are covered nationwide. That's 15 million accounts protected. You're statistically safer than you think. Next week, we're diving deeper. Joint accounts, retirement accounts, trusts. Every deposit category with real money examples. Until then, your money is secure. The system actually works.